All right, just a quick heads up before we dive in. This is experimental educational content and it's not financial advice. Please use this as a learning tool and always do your own research. Have you ever wondered what really separates a consistently profitable trader from someone who's just riding a lucky streak? I'll give you a hint. It's not some secret, complex indicator. It's actually just simple math. So, in the next few minutes, we're going to cut through all the noise and figure out if you have a real mathematical edge in the market. Let's jump in. So let's just ask the big question right up front. Is your trading strategy actually profitable, over the long haul? Well, to figure that out, we're going to break down the two most important numbers you need to know. And you're going to want to stick around because I'll show you a super simple drill to calculate your own numbers in less than 5 minutes. Okay, our first concept is called expectancy. And honestly, this is the absolute bedrock of any solid trading strategy. Think of it this way. It tells you, on average, what you can expect to make or lose every single time you click that buy or sell button. So, expectancy, or EV, as you'll often see it called, is what you'd average out to if you took the same type of trade hundreds of times. Now, if that number is positive, you've got a statistical edge. But if it's negative, well, no matter how good a winning streak feels, you're mathematically on a path to lose money over time. Simple as that. And here's the formula that powers it all. It really is just a simple balancing act. On one side of the scale, you've got your win percentage multiplied by your average winning trade. And on the other side, you've got your loss percentage multiplied by your average losing trade. The difference between those two, that's your expectancy. That's your average result per trade. And this brings us to probably the single biggest trap for new traders: chasing a high win rate. I mean, it feels amazing to win 9 out of 10 trades, right? Of course it does. But if that one single loss is so big that it wipes out all 9 of those wins, and then some, well, your strategy is actually a loser. And that's the key difference. Amateurs chase wins, pros chase positive expectancy. Okay, so concept number 2. This one builds right on top of expectancy, and it's called the profit factor. Now, if expectancy is like a snapshot of a single trade's potential, think of profit factor as the big picture performance review for your entire system. The profit factor answers a really simple question. For every single dollar you lose, how many dollars are you making back? It's just a ratio. If that number is greater than 1, congratulations, your strategy is profitable over time. And obviously, the higher that number is, the healthier your system is. And look how simple this formula is. You just take your gross profit, that's all your winning trades added up, and you divide it by your gross loss, all your losing trades added up. That's it. Couldn't be easier. Now this is where it all comes together. Just look at this example. This strategy loses 60% of the time. Let that sink in for a second. You're wrong more often than you're right. But, and this is a huge but, because your average win is 3 times bigger than your average loss, your expectancy is a positive $60 for every trade you take. This strategy is a money-making machine because the size of the wins completely outweighs how often you lose. That is the magic of positive expectancy. Okay, enough with the theory. It is time to get your hands dirty. Go ahead and grab your trading journal or pull up your history because we're going to run a super quick drill to find out if your strategy has a real bona fide mathematical edge. It's just 4 simple steps. First, I want you to gather the results from your last 50 trades. Second, do a little math and calculate your win percentage, your average win size, and your average loss size. Third, plug those numbers right into that expectancy formula we just talked about. And finally, number 4, calculate your overall profit factor. So what's a passing grade here? What does your report card need to say? It's really simple. You're looking for an expectancy that's greater than 0 and a profit factor that's greater than 1. And here's a pro tip that's absolutely critical. Always include your commissions and fees in your losses. Those tiny costs add up, and trust me, they can be the difference between a winning system and a losing one. So what's your next move? Look, don't just do this once and forget about it. Make this little drill a weekly habit. Track your EV and your profit factor like a hawk. And if you see those numbers start to dip, you'll know exactly what to do. You either need to figure out how to make your winning trades bigger, or you need to get a little more selective to improve your win rate. See? This isn't about guesswork anymore. It's a clear, data-driven path to becoming a smarter trader. Just to wrap up, please remember this explainer is for educational purposes only, and it is not financial advice. All markets involve substantial risk, which includes the possible loss of your principal. Past performance doesn't guarantee future results, and you should always verify your own data, fees, and assumptions before placing any trades.